A very good morning to all of you. It is very heartwarming to see that so many of you have traded their bets for this cozy venture that we have here today. May I offer you therefore a very warm welcome on the annual KBC Securities Sustainability Conference in cooperation with KBC Corporate Banking. As you know, we are broadcasting live from Brussels today. That means we are prone to any kind of unwelcome hiccups. Should they occur, despite the fact that we've experienced massive experience with COVID lockdowns, it might still happen. If and when those hiccups should occur, do not panic. Sit aside, stay calm, take another sip from your morning coffee and know that we will be right back with you. We have today a menu that consists of one webinar and two panel discussions that focuses on the non-financial reporting, as you know very well due to the invitation. In 15 minutes time, we'll discuss in detail the non-financial reporting in light of the EU disclosure regulation. We'll do that with PricewaterhouseCoopers and KBC. At 1:30 p.m., our project finance team will participate in a discussion with different actors in the energy market on the Belgian offshore wind energy. And lastly, but surely, at 3 p.m., our export finance team, together with some of their core clients, will discuss in detail and they will zoom in on how the United Nations SDGs can be applied, can be used in export financing transactions. All sessions today can be accessed via the link that you just now used to log in to this introduction. So that's important. Even when you should go out, no problem. Just use the link, reconnect, and we will see each other again here. Know that all of the sessions today will be recorded, and we will provide you with a link to all recorded sessions afterwards. So no worries if you will have to skip one of those links, one of those sessions. You can review them afterwards. Importantly, all questions will be answered. This is a live Q&A, so at any time, during, before or after the sessions, should you want to pose any questions whatsoever, we will provide you with an answer, either directly or indirectly. That can be via mail or via your relationship manager. So far, so good. But of course, you did not log in for this kind of introductory flattery. You did log in to see the magic happen, and this is exactly what we're going to do right now. Therefore, I'm very happy to introduce Philippe Ferrante here with us now. He is a General Manager Group Corporate Sustainability at KBC Group. Philippe ensures that the sustainability is an integral part of KBC's corporate strategy, and he'll explain to you in detail just how important and how he ensures that KBC Group's corporate strategy and sustainability strategy is applied. Philippe will also provide you with some experience-based suggestions on how companies can tackle the sustainability issues, and especially he will do that in no more than 15 minutes. So this will be light but very interesting. Philippe, may I offer the floor to you?
Thank you very much, Tom. Glad to be here. Also from my side, a warm welcome to all of you. Sharing our approach and our knowledge on sustainability with customers such as yourself is indeed part of what we see as our role on how we can assist our customers in transitioning to a more sustainable future. And as Tom rightfully mentioned, we do believe that it's of key importance that sustainability is embedded in a corporate strategy of a company, an integral part of that corporate strategy. And this is how we do that at KBC. At KBC, we have our corporate strategy, and one of the pillars of our corporate strategy is that we want to play our role in society. And how we do that, playing that role in society, that is immediately the input for our sustainability strategy, which is quite easily explained as reducing our negative impact on society, increasing our positive impact on society, and all that based on a solid foundation of responsible behavior on behalf of all our employees. Now, for those of you that are a bit familiar with sustainability, you will recognize some symbols on this slide, which are indeed the United Nations Sustainable Development Goals. They are for us a guideline, but we do select what we believe to be high impact areas for a financial institution. If you look at the ones that we've selected, we believe that those are the sustainable development goals that are closest to our core business. We do think that that's an important thing that all companies should do, select your high impact areas. Do so voluntarily today so you can start building that sustainability strategy, because indeed, and that will be the discussion point of the next speakers, we are heading towards mandatory disclosures. So do start with making that selection yourself. What we highly recommend is that you double check this selection on a regular basis. We do a materiality assessment every 2 years. And in that materiality assessment, you check with both management, but also very important, with external stakeholders to see whether the topics you are focusing on are still the right ones. What we also believe is very important, that you should move to a structure where sustainability or the sustainability department is not a standalone department. When you want to make progress on sustainability, we believe all companies should ensure that business, that frontline expertise, is also involved in sustainability. How do we approach this as KBC? Well, we have a quite solid governance structure. It obviously starts at the board of directors. The voice of the top of the organization is extremely important when it comes to sustainability. And at KBC, at least 2 times a year, there is a discussion on the board of directors with regard to sustainability. But then also inside the organization, you have to make sure that you bring together all the necessary expertise. How we do that, particularly at KBC, is we have a body, it's called the Internal Sustainability Board. The name is not really important, but what is important is the composition of that board. In that board is our group CEO, again, the importance of the top, our group CFO, because we're talking about reporting, also that will be a topic of discussions of our next speakers. But then, very importantly, there is representation of all the CEOs of our business lines. We think that that is key, that it's not a standalone department, a standalone body that decides and then leave implementation to other people. No, the people responsible for the implementation, the CEOs of our most important countries and our business lines, are actively involved. Obviously, other people then need to take over and make sure it's locally implemented, but at the decision table itself, the key decision makers are there. What is also interesting, I believe, in our approach is that besides the internal organization, we also have permanent external challenge. We work with 2 external challenge boards. Why is this important? In sustainability, keeping an eye on the outside world is very important. We work with a specific external board when it comes to our asset management division, where the board is helping us to select companies that go into our responsible investment funds. And then there's another board that indeed is taking that role of a permanent view on society, a permanent stakeholder reflection on all the sustainability themes that we look at. Now, once you've done so, once you have the governance structure, once you have selected material topics, then obviously you can go on report on those topics. I'm not going to dwell in detail on this slide, but this is just a slide from our sustainability report of 2021, where we indeed show where we have been focusing on with regard to the E of environment, the S of social, and the G of governance. You can do so if indeed the material topics are the ones that you have followed up and have set, and that's also a next step, set targets on. And that is also something that we highly recommend. If you have selected topics correctly, dare to set targets. Set them also publicly. We have set targets for a while now. We are showing with the targets what we're doing in sustainability, very close to our core business line. And we think you shouldn't be afraid to disclose. Again, disclosures are going to become mandatory under the regulations that will be discussed during this morning's session, so you might as well get used to it. The next step that you then could do when you publicly disclose your targets is an internal step, and that is linking certain of those targets to variable remuneration. Also, that is being practiced at KBC, where the board of directors receives a dashboard with all sustainability metrics and uses that dashboard to determine a part of the variable remuneration of the members of our group executive committee. Also, for all general managers within KBC Group, at least 10% of their variable remuneration is linked to a personal target with regard to sustainability. Now, when it comes to setting targets, also that is evolving. You might see it on the slide that we actually have already achieved some of the ambitious targets that we set a while ago. And that immediately leads me to the announcement that KBC is setting additional targets. And the additional targets that we are setting will become available early next week, mid next week, as KBC will be publishing its first climate report. In that climate report, we will show, as part of our commitment to align our products and services to the Paris Climate Change Agreement, we will show how for the most important sectors, we will set targets on how we're going to reduce CO2 emissions by 2030 and by 2050. Again, this is very impactful. We really have aligned this with the business because we want to start steering via those targets on our business. This will be in our lending portfolio and also in our asset management business. This was a very short introduction to how KBC is approaching sustainability. If you're interested for more information, you can always discuss with your relationship manager, or on our corporate website, you can find our KBC Sustainability Report, where there is a lot of additional information. With that, back over to you, Tom.
Thank you, Philip. It's very interesting. I look forward to the publication of the climate report, so we will keep in touch, of course. But that having said, it's now time to move on to the first session of today's conference on the topic of the non-financial reporting and the EU disclosure regulation. We will be right back with you. Stay tuned. Give us 2 minutes. All right, welcome back. So the first session is about to kick off, and then I'm very happy to introduce Marc Daelman, partner at PricewaterhouseCoopers. Marc is responsible for sustainability services within PricewaterhouseCoopers, Belgium that is, and he ensures and assists companies with developing their sustainability strategies and also the reporting internal and external of the sustainability reporting. Alongside his duties, and this is quite interesting, as chairman of the jury of the Belgian Award Best Sustainability Reporting, Marc is a close follower of the legislative initiatives of the framework in financial or really non-financial reporting. So Marc, in particular, CSRD and EU taxonomy is part of his job. We're very welcome to have you here, Marc. Thank you so much. Secondly, we have Luc van Goethem in our midst from KBC. Luc went through the financial crisis with KBC as a communicator and guided KBC through that difficult period, and afterwards started as a central data steward at the Data Quality Management in 2015. He created awareness for data quality and his governance throughout the KBC Group. Afterwards, in March 2022, so that's quite recent, Marc joined the Sustainability Disclosures Policy Advice Team at Group Finance. Marc follows up quite closely on existing regulation and new regulation, which makes both partners here quite complementary. Very much welcome to you, Luc, as well. Marc, may I invite you to take the stage first?
Thank you. Many thanks for this introduction, and many thanks. It's a privilege for me to be here, and welcome everybody. Good morning. For today, indeed, I will try to guide you through the regulatory environment in view of the non-financial reporting. But before we do that, I think it would be good first to give a definition. Okay, but what is it about? What is ESG? And how should a company, in fact, determine the scope of ESG in its financial reporting? And also to avoid that it becomes too dry in view of the regulatory environment, I'm also privileged to have Luc here next to me, that we will also be able to illustrate that how KBC Group as a group has also approached the non-financial reporting. Of course, also we will go through the challenges we see for companies in view of that regulatory need for mandatory disclosures. How do we see companies approach that? What are the typical challenges we see for companies? We need to give that tips and tricks really to help you out with that. Also, our last session will also be very short about the role of the auditor, because it is clear that in that regulation that the audit will be mandatory. But let us first maybe start with what is ESG, because it is clear that if you look today that there is an increased attention to non-financial reporting. It is clear that if you look to the corporate reporting of today, that there is a lot of information needed beyond really the financial reporting. If you look to, for instance, the risk survey, which is done annually by the World Economic Forum, and you would analyze it over the last decade, and you look to the top risks which are really listed in this year's annual risk survey, you will see that there are top risks like extreme weather, climate action failure, human environmental damage, biodiversity loss. These are typically environmental risks which are becoming now top priority risks, but which are, if you look to traditional financial reporting, were not that in detail sufficiently disclosed in the typical financial reporting. That's where we see really the need for enhanced non-financial reporting. But of course, if we look to the different terminologies used, I'm already for more than 30 years within corporate reporting. And if we had information about the not typical financial reporting, we talked in the early days about an environmental report that gradually evolved towards a CSR reporting, the corporate social responsibility reporting, whereby companies have given also additional disclosures about what is our role as a company within society. But that has further evolved, and now we are talking about sustainability reporting. The word sustain means having a long-term view about the business, about long-term objectives. And also we are talking about ESG. So really the dimensions of environmental risk and opportunities, social and governance. And on the slide you see a kind of a universe of domains which are typically approached within ESG. You see the different domains of environmental reporting, social reporting, as well as governance reporting. Of course, it is very important to see then how you will scope the report, and come back to that. Of course, you might say, from where now the sudden increase in attention in the non-financial reporting, and I referred already to the World Economic Forum, where we see the priority risks becoming the type of environmental risks. However, what we typically also do is with companies having the conversation about, if you look to your business strategy and you set long-term objectives, okay, have you thought about the typical mega trends that we see in this world? Have you thought about climate change? Have you thought about resource scarcity? Have you thought about demographic change? We have an aging population, we have the rapid growth of the population. We see also economical shifts towards certain regions with accelerated growth. So how have you adapted, or how will those typical risks and opportunities following those mega trends impact your strategy? How will you be enabled to realize your long-term objectives, whereby that you might be faced with a scarcity of your materials. You might be faced with a scarcity of skilled people within your organization. So, and these are typically the domains where you say, well, if we look to the non-financial information, where we see an additional pressure internally to think about those environmental, social, and governance risk and domains, to embed that in your business strategy. But it's not only internally. We see also that international organizations, bodies, also are pressing companies and governments, countries, to think about long-term objectives. And I make reference here to, for instance, the Paris Agreement, one of those. You can also refer to the United Nations Sustainable Development Goals, where these are pressing also companies and countries to report accordingly, have a view on how climate change, to give that as an example, will impact all of us. Also, we have seen that there are a lot of voluntary schemes popping up in view of non-financial reporting, but also rating agencies scoring companies in view of what is the maturity of the non-financial strategy or the sustainability strategy of a company. And I make reference to voluntary schemes like GRI, TCFD, CDP, IRSC. So there are a lot of voluntary schemes. And we are also the rating agencies scoring companies on their ESG strategy. And all of that, of course, is also not without consequence. Companies putting non-financial commitments, sustainability commitments in the market are also more and more held liable for that, accountable for that. And we see also popping up litigations by NGOs or other stakeholders really making companies accountable for those commitments put into the market. Also, and the last dimension is the investors. If you look to investors, how they screen companies, they also more and more screen companies in view of their ESG strategy, in view of their ESG maturity, also to see, okay, but how are those environmental or social risks identified and mitigated in the business strategy, but also where are those opportunities of accelerated growth. So you see there are a lot of global megatrends and stakeholders' pressures really to adapt business strategies in the light of ESG risk and opportunities, but also the corporate reporting accordingly. And you can imagine if we then look to that universe of social, environmental, governance domains, that it might be very challenging for companies. How should I now determine the scope of my reporting? And here I already indicated that on one hand, it is very important to reflect internally with management throughout the organization of what are those risks and opportunities, what are those domains which are really relevant for us in view of realizing our long-term objectives. But it's also very important to listen to your stakeholders, the various stakeholders around the company, and that's very a crucial process in defining the scope of non-financial reporting. So, and typically the stakeholders are those stakeholders which might be impacted by your decisions as a company, or stakeholders which might impact your business decisions. I make reference here to employees. Employees, if you want to attract the right people, skilled people, retain people, it's also important to be very transparent about your culture, about your values, whereby potential employees can also have a look at to what extent is that aligned with my values. Also in view of consumers, if there is a change in consumer behavior, how do you need to adapt your product portfolio, your service portfolio accordingly? If consumers or customers have clear commitments in view of climate change, how you as a company being part of that supply chain, how does that impact your footprint? How does that impact your supply chain? So these are very important elements really to have that engagement with your stakeholders to determine what are those domains within environmental risk and opportunities and in view of social governance, what are the most relevant domains which might impact my business strategy, which might impact also the impact I have as a company towards the world. Also important is that, and that's what we talk about, and we will come back when we also discuss the regulatory environment, is you do not only look to your own footprint, you really have to apply what is called the double materiality. So as a company, you have a certain business strategy, you have a certain footprint, and you will analyze what is my impact on the world. But you will also need to have a look on what is the impact of those megatrends of the world on my business, on my footprint. So as always, with two lenses that you need to look to your company, to the outside world. And that's what we call the inside out or the outside in view. So on the one hand, you look, what is my impact on the world? I have a certain footprint. I have a certain quantities of carbon emissions on a yearly basis. How can I reduce? How can I mitigate? But also, you have to look on, we have the Paris Agreement. There is a pressure, an important pressure, really to reduce impact, to align towards the Paris Agreement commitments. There will be an important shift or transition towards a low carbon economy. How does that impact my footprint? How need I to adjust my business model, my footprint accordingly? So always important, if we look to non-financial information and if we need to scope the domains of the non-financial information, that we really look with the two lenses to the impact that we have on the world, as well that the impact that the world is having on the business. And we typically, if we have those conversations with companies, to have an appropriate structure, we try to structure it somewhat in different buckets. If you look to the non-financial information and to those risks and opportunities, there will be risks and opportunities which might accelerate your growth or limit your growth. So there are social and environmental trends which will enable you maybe to differentiate or to apply new technologies which might accelerate your growth, whereby you might be more successful in realizing your long-term objectives. However, there might be other elements where you say, well, if I adapt my business model, my footprint, I can reduce costs. If you reduce carbon emissions because you have been able to reduce electricity usage, well, you will reduce your costs, which is a clear business case. It might also enhance your reputation. If you want to recruit the right skilled people, retain the right people, it's also important that you have, you build up your reputation, your culture, so there might be a positive impact towards your reputation. It's also a matter of managing risks. If you look to climate change, there's clearly a risk of physical risks because of climate change. Also, there's a transition risk. How will you adapt your business model to mitigate those risks? Also, if you then look to your impact towards the world, it is a way how we can reduce your impact or also be there for a cause of good. Your role as a company within society. So you see that you can, if you look to the scope of non-financial information and the risks and opportunities, it's good to have that view of where can we drive growth, how can we minimize costs, how can we enhance our reputation, so the different buckets, how we can structure really your view on non-financial information. Having said that, it is of course a very iterative process, because I indicated that you start with your stakeholder analysis, your internal view on your business model, on your strategy, that you will determine your material domains, the relevant domains within that space of ESG. And you will set your managed approach really on those domains which are really relevant to you. You implement your strategy. You set KPIs to monitor your performance in accordance with your strategy. You set targets. You will do the necessary internal dashboarding to monitor your performance against your strategy. You will have your external reporting, and your internal dashboarding and external reporting will also enable you again to maybe further refine your strategy, rethink your material domains. So it's really an iterative process of analyzing, adapting your strategy and reporting. It's quite important to see really the flow and how that can really accelerate further your growth or your focus. But maybe a good look if we can illustrate that, how KBC Group has approached that.
Yes, indeed. Let me add a few comments here. Because indeed your corporate sustainability strategy is very important in order to deal in the correct way with your impact on the world, but also with the world's impact on yourself. So when building and keeping up to date a sustainability strategy, you must well be aware of the context that you are operating in. So that means basically two things. Firstly, a good knowledge and engagement from your main stakeholders. And secondly, you need to be aware of what keeps them awake at night. So let's talk about stakeholder engagement, referring to the slide here. So that's the process by which an organization identifies and involves people that either may be directly affected by the decisions your organization makes, or that may be influenced by the implementation of your decisions. So maintaining an open and constructive dialogue with its stakeholders has always been very essential to KBC. So we continuously connect with a number of stakeholder groups, which you see here on the screen. So clients are included, staff members, of course, investors, core shareholders, suppliers, public authorities, name it. And they all have their expectations towards their future, and they all have an idea also about what they would expect from us in the sustainability field. So I'm not going into the detail here. You can find all details on the kbc.com website. But we do keep the dialogue going with all these stakeholder groups, and there's a wide variety of actions defined. This is one of those actions, for example. But please check out the sustainability report for that. So next to these groups, I should also mention that we keep the pulse on what's going on in the world by our external advisory boards, where you have a number of specialists that challenge our strategy, well, basically continuously. So knowing your stakeholder is one thing, but there's also finding out what keeps them awake at night regarding sustainability. And that's why we do a biannual materiality assessment. So that will enable us to or to correct our sustainability strategy to better meet the client expectations. It will also allow us to adapt our reporting efforts in the sense that we report more on the things that our stakeholders want to learn about. So this assessment is basically a self-assessment. How does it take place? So every 2 years, we first identify the relevant stakeholder groups. That's referring to the other slide. Then we put together a short list of 13 relevant material topics in the sustainability field. And you see them listed on the right side of the slide. Then we asked a number of internal and external stakeholders in all our 6 core markets to draw up their priority top 5 of high impact matters, topics that they think that we should be working on. And the outcome is a materiality mix. That's the graph in the middle of the screen, where you see on the y-axis the importance of the topics that our stakeholders identified, and on the x-axis you see what our management identified as priorities. I didn't mention this, but our internal audience, to which we asked them to provide the top 5, was basically our senior and our general management layers in all of the core countries of KBC. So we reduced a long list of 13 topics to a top 5, which you can see on the lower left corner of the screen. So the highest impact topics in 2020 were first, long-term resilience of our business model, sustainable and responsible lending, insurance and advisory services, ethical business conduct and responsible behavior, sustainable and responsible asset management and investing, and also being a partner in the transformation of our clients towards a more sustainable future. So the conclusions of this materiality assessment have been discussed and validated by the internal sustainability board that Philip already referred to, but it has also been discussed on our top level, so on the group executive committee and also on the board of directors. Now in the next slide, you see on the left table how these 5 material high impact topics can be mapped on the KBC corporate strategy. And you see there that they all refer to our role in society, the bank insurance model, and sustainable and profitable growth. So that's pretty interesting. But they also map, and you see that on the right side of the drawing, to the different sustainability development goals that KBC chose as a priority. And that's also the reason why you see them on the diagram on the right-hand side of your screen. They all nicely fit into the corporate sustainability strategy of KBC. So as a conclusion, you can say that KBC listened to its stakeholders when first putting together the corporate sustainability strategy, but keeping it up to date also. So because it does include, the strategy does include the highest impact material topics that were identified by internal and external stakeholders. More information on that, please check out the corporate website.
Interesting introduction. We have received quite some number of questions, so that's great. Don't hesitate to keep sending them over. I propose I just drop them in your hands, and then you have to see how and who can answer it. One was interesting. It was a question about client asking, when I provide KBC with non-financial data, will this have an impact on the credit process? So probably the credit rating is mentioned, and or conditions of my loans.
What I would suggest, if it is fine for everybody, that we keep the questions at the end, and that we first now give an overview of the regulatory environment, and then that we then maybe block together the questions at the end, if that is fine for you.
Okay, good. Yep. So again, if there are questions, keep shooting, and then we'll answer them in the end. Good.
Absolutely. Many thanks for that.
Yes.
So maybe important now, we have somewhat presented really the building blocks of non-financial information, being the stakeholder engagement and the materiality assessment. And you will see when we will touch on the regulatory environment that those building blocks will come back. It's really fundamental in view of setting up non-financial reporting, but also setting up your ESG strategy. And of course, it will not be surprising when we talk about the regulatory environment that we will talk about the European Green Deal. Really the center of the current regulation is really the EU Green Deal. The EU Green Deal really having, the EU has set the objective of the Paris Agreement, and that's very ambitious. And in view of moving Europe towards a climate neutral, the first climate neutral continent by 2050, there the EU has seen, okay, we have really the need for a set of policies, procedures, really enabling us to transition to that climate neutral continent. Because they realized very quickly that if you look to the investments required to transition the economy, that it is massive. We are talking about 180 billion of annual investments in view of making that transition. So in making that transition, it will become also clear that the financial sector and investors will be very crucial in the middle of that, because they have that possibility to steer the capital flows, the investments, towards sustainable economic activities. So they have a central role in that field of transitioning really the capital flows. And you will see, if we will go through the regulation, that the regulation has made it possible in view of those financial institution investors to make that selection of sustainable economic activities. And if we look to that action plan of the EU, so there are 3 important domains. You have a domain of reorienting capital flows towards a more sustainable economy, which I was alluding to earlier. It's mainstreaming sustainability into risk management, and also important, fostering transparency and long-termism. So 3 important actions which they have split up in 10 concrete action plans. And for today, I will focus on 2 of them. The first one, in view of the objective of reorienting capital flows towards a more sustainable economy, we will touch on the EU taxonomy regulation, a classification system. I'll come back to that. And the second one, which we will touch on, is strengthening sustainability disclosure and accounting rulemaking, which is the CRSD. It's really the regulation around transparent, balanced, non-financial reporting for companies. So these are the 2 key domains that we will touch on in the course of this presentation. And maybe let us first start with the EU taxonomy. What is the EU taxonomy? It's clear if I indicated that it is important to reorient capital flows towards sustainable economic activities, that one need to define what is a sustainable economic activity. And that's really the objective of the EU taxonomy. The EU taxonomy is a kind of classification system in which they have defined, based upon a taxonomy, the economic activities, and whereby companies have to screen their economic activities and present them as EU taxonomy aligned or not. So that's really the combination of, and we will go into the screening in more detail, combination of looking at my economic activities based upon sustainability criteria, technical criteria, and reporting that financially, looking to your turnover, looking to your operating expenses, looking to your capex, your investments, and giving that proportion of how much of my turnover is now EU taxonomy aligned, sustainable, a sustainable economic activity, and which proportion isn't. And the same for OPEX and CAPEX. They have also given a methodology how to determine now for a company what is sustainable aligned. And there are 3 important screenings. One is really a technical screening. So you will split up your activities, economic activities, and based upon those economic activities, you will screen them based upon technical criteria, thresholds set by the EU, by which you will see that, okay, can I meet those thresholds? Can I see that economic activity as being a green activity, to give that an example as for in view of the environmental domains, or isn't it? So really based upon technical criteria, that's the first screening to be done by companies. But that's not sufficient, because the EU has set different environmental objectives, and there will be also social and governance objectives. There are different environmental objectives. The first 2 are about climate change. So you will split up your economic activities. You will look, okay, how do my economic activities contribute to climate change mitigation or adaptation? You will look the threshold. If you are indeed meeting that threshold, you will say, well, this is a sustainable activity. However, the second screening will be, okay, having seen also the other environmental objectives, can you also demonstrate that you do not significantly harm the other environmental objectives? Because you can be very good contributing towards climate change, but are you also sure that your economic activity is not harm significantly, for instance, water usage, pollution, the biodiversity, so the other environmental objectives set by the EU. That's the second screening. The third screening is then also important. There, you have to also to demonstrate that your economic activities comply with minimum safeguards. Minimum safeguards in the sense of, do you have a responsible conduct? I'm referring there to the OECD guiding principles, the United Nations guiding principles on business and human rights, International Labour Organization conventions. So it's really important also that not only you have to demonstrate that you meet the technical thresholds, that you do not significantly harm other environmental objectives set by the EU, but also that you meet up in view of the minimum safeguards of business conduct. So only then you will be able to report your proportion of turnover as EU taxonomy aligned. And I indicated that there are 6 environmental objectives, of which that today there are only 2 of them in detail available in view of guidance by the delegated act. So those which are available is climate change mitigation and climate change adaptation. We expect by year-end have also the other 4 environmental objective guidance in view of protection of water, transition to circular economy, prevention of pollution, and biodiversity. The ones around the social and the governance domain are today under development. You see already quite a guidance in view of the 2 environmental objectives available, but there's much more to come in the months and years that we have in front of us. So that's about the EU taxonomy, a kind of classification system by which companies transparently need to report upon their proportion sustainably aligned activity compared to non-sustainably aligned activity. The second regulation is the Corporate Sustainability Reporting Directive. Today, we have the NFRD, a lot of acronyms. We have the Non-Financial Reporting Directive, which is today already applicable for the big listed companies, the quoted companies. Tomorrow, we will have the CRSD, so the Corporate Sustainability Reporting Directive, for which that the threshold is much lower than what we have today. So much more companies will fall into the scope of this directive. So the scope is not only because of the threshold which has been reduced, but also the scope has been enlarged, where it was previously only the big listed companies. Within the CRSD, it will not only be the listed companies, but it will also be all large companies meeting the thresholds. And the thresholds are set as 2 of 3 criteria to be met: 250 employees, 40 million of turnover, and 20 million of total assets. You see, there's quite low thresholds. We expect that a lot of companies will fall into the scope of the CRSD.
I think some 50,000.
Yeah. So it's an enormous scope extension compared with what we have today in view of the non-financial reporting. But not only the scope in view of the companies has been extended, but also the scope of what has to be disclosed by the companies. And again, not surprisingly, I will refer again to materiality. So the double materiality, which I referred to earlier, has to be applied. So it's foreseen within the current regulation, but also the process of how we have come up with the material domains. So your stakeholder engagement, how we have engaged internally, externally, has to be very well disclosed within your reporting. Also, there will be forward-looking information, including targets, progress against those targets. There will be description of your risk management, your business model, very narrative to be foreseen also in your disclosures, as well as very concretely also qualitative, but also quantitative information, really your KPIs, your performance on those material domains has to be disclosed as part of the CRSD obligation. So you will see that not only the number of companies in scope, but also what has to be disclosed is quite comprehensive. It is the EFRAG who is currently writing out the standards, and these are called the ESRS, the EU Sustainability Reporting Standards, which are today available. They have been in consultation process, which has now just closed the consultation process, so they are gathering now all the comments received upon those standards. So they are in further development, so they are not yet fixed, and they are further in development as of today. But you will see that there is a whole set of standards which are in development, and they are quite, fair to say, quite lengthy. We are talking about hundreds of pages of standards which will become mandatory for companies in view of disclosing their non-financial information. And you will see that there are some cross-cutting standards, which general principles of reporting, also about the general overview of your governance, your risk management, your management approach, but also that there will be very specific standards in view of those ESG domains. So you will have a specific standard, for instance, the ISRS E1 on climate change. You have one on pollution. You have one on water and marine resources. So on the different domains, environmental, also social, specific on, for instance, on workforce and the supply chain, also on governance. There are each time a specific standard which will oblige companies to give qualitative disclosures as well as quantitative, really very specific KPIs, how you monitor your strategy, how you monitor that you are mitigating your ESG risks, very quantitative KPIs on performance. So both sets of disclosures, and it's quite comprehensive in view of the number of disclosures required coming up. Coming up, maybe good to give the timeline. If you look to the timeline, for those companies already in scope as of today as part of the NFRD, so the listed companies, there the timeline is that they will need to comply with the CRSD as from their annual report in 2025, so giving the performance over 2024. In view of the large companies, the large undertakings, there the first reporting will be by 2026 over the period 2025. You can believe that, that's still a long time ahead of us, but given how comprehensive that set of disclosure is, I think it's really time to act now and to be prepared for that wave of additional disclosures coming up. So, and really with the objective that reporting is transparent. The reporting will also be accessible through digital means, because there will be a digital tagging of that non-financial information coming up. It will be a very standardized reporting, applicable for all companies, with the focus on those material domains which are important, relevant for your company, based upon your materiality assessment, but which will enable comparability with your peers, with other companies, because it will be set up in a kind of a standardized way of mandatory disclosures. And it will also be robust, because important to indicate as well that what was not foreseen within the NFRD regulation, that with the CRSD regulation, the audit is mandatory. So as from the reporting will become applicable in 2025 or 2026, the audit will be mandatory, which also will enhance the robustness of the reporting. Very important. I hope that gives you already a first idea of what's coming in front of you in view of the comprehensiveness of the disclosures. What we typically see with clients today, and if we go through really what the regulation is, a number of challenges where we really recommend clients to have a look at. One of those challenges is, given the comprehensiveness of the disclosure requirements, really have a thought about controls, processes, procedures in view of being able to collect that data, analyze that data, not only for your external reporting, but also for your internal decision making. Ensure that you have a robust process of policies and procedures and systems set up. Not only processes and systems, but also upskilling your people throughout the organization. Is it within business? Is it within finance? Is it the board, audit committee? Because it will fall under the responsibility also of the audit committee and the board. So it's really upskilling the people in the domains of ESG. And I have illustrated somewhat also the hybrid form of reporting, because it is about sustainability indicators, but reporting financially, proportion of turnover, CAPEX, OPEX. It's clear also that you need to have that, really that mix of people of business people, communication people, finance people, ensure that you have really that diversity in your project teams, being able to cope with that additional layer of disclosures. Synchronization of internal and external communication will also be very important, really demonstrating that integration of your ESG strategy within your overall business strategy and within your overall long-term objectives set internally or externally. And also, I think very important, and maybe to start with, is that, start already with a gap assessment, and that you really can see, based upon your reading of the new regulation, where do you stand today, what are the challenges, prepare your roadmap in view of implementation, being able to comply with that regulation, but also being able to adapt your business model, your strategy accordingly. I think these are important challenges to put forward already as of today in order to enable you to prepare for that journey of sustainability reporting. A typical roadmap, what we see with clients, I illustrated here on the presentation, is you start from what we indicated, the stakeholder engagement, identifying that those material domains, align your strategy, and incorporate sustainability strategy, ESG strategy within your overall business strategy, and then setting up your governance model. Who is responsible for what? What are the roles and responsibilities on the ESG domains? Also in view of reporting, will you integrate non-financial reporting within your financial reporting? How will that be set up? Transformation roadmap, how will you embed those ESG focus areas within the business? Prepare action plans with clear objectives. Define KPIs, because how will you monitor your performance against strategy? Set targets. Implement that, gather the data, gather your performance against your strategy. Think about internal and external communication, but then also because I alluded to the fact that it will become mandatory assurance, so external audit, also start with the preparation of the assurance. Are you sure that your KPIs are well defined, that there is an audit trail, that everything is properly documented, that you can trace back to the source documentation, that your an audit will be that you will be able to undergo an audit as well at the end of the day in the year of mandatory auditing. So I think that's a typical roadmap that we see with clients as of today and setting up that journey of non-financial reporting. But maybe good again, look that we see how KBC Group has really implemented that as well in their annual reporting and strategy.
Yes, indeed. Let's shine a light on a few use cases. So let me first mention that KBC has a very long tradition in activities in the once called corporate social responsibility domain, and we've always invested a lot in communication about that. So we have our sustainability report, which was created in 2006, hence then called the CSR report. We added a more condensed version, the report to society, in 2011, and gradually over the years, more and more sustainability information was integrated in the annual reports. That was a gradual build-up. Now, especially the annual report is something we pay a lot of attention to. We take the financial information very seriously. We built an entire 3 lines of defense model around it, and there's always external assurance for that. But for the sustainability reporting, until now we used a variety of standards. TCFD, GRI, SASB are the main ones, in fact. But in the future, we'll see shifts towards the CSRD standards without any doubt. Now, as the CSRD indicates that the annual report should be your legal source for your financial as well as your non-financial information, because there's a lot of mandatory disclosures that need to be fulfilled. This sustainability information must reach the same quality and must have the same credibility as your financial information. Now, in order to reach that level of quality and of credibility, you need to set up a lot of things, and we are in fact still setting up those things because the CSRD is still also in full development, and first CSRD compliant reporting will probably be the case for KBC from 2025 on, spanning the financial year 2024. So we are currently organizing ourselves in order to meet those very far-reaching, as you indicated, disclosure requirements. But that doesn't mean we are just sitting and waiting for the CSRD to come. No, we currently already prepare and even do a lot of ESG reporting, and I would like to take you through 2 examples in that field. So there's reporting as a logical consequence of the agreements that we, or the commitments we signed, and there's the collective commitment to climate change, which I want to highlight. And the second will be the EU taxonomy, to which you also have made already reference. So let's talk about the CCCA. So as Philippe Ferranti already said, we published a number of corporate policies and guidelines. So it was a logical consequence for KBC to show some commitment by endorsing some of these initiatives. So in 2018, we endorsed the United Nations Principles for Responsible Banking, which meant that we committed to align our business strategy with the sustainable development goals as defined by the United Nations, but also with the Paris Climate Agreement. By the way, we also signed similar agreements in the investment and in the insurance world. So in 2019, we followed suit with signing the collective commitments to climate action. And as such, we committed ourselves to act a bit faster than the original PRB commitment. So the CCCA commitment is consistent with a maximum temperature rise of well below 2 degrees above pre-industrial levels by the end of the century, equivalent to non-zero by 2065. If you want to know what this all exactly means, please look on the internet. I could be spending a couple of hours on that, so I'm not going to do that. So as such, a signatory of the CCCA needs to fulfill 3 things. First of all, he or she needs to take decisive action from the moment of signing, focusing on the most carbon-intensive activities and the most climate-vulnerable activities that you have in your loan and lease portfolios. So also within 3 years of signing, we need to set and publish sector-specific targets. That's what we are going to do next week, as announced by Philippe. And thirdly, you need to drive and facilitate the necessary change in the real economy through client relationships, products, and services. So an active role of KBC is expected here for driving and facilitating the necessary transition to a better world. Now, the CCCA is only for banks, and more specifically for the loan and the lease books. Now, what do we need to report on? Well, we annually need to report on the progress that we are making. And the main figure, the main key that we need to report on are those famous Scope 1, Scope 2, and Scope 3 greenhouse gas emissions. So the Scope 1 is the direct emissions that you create yourself, in fact. That's for heating purposes, for example. You would consume some fuel, and there's some emissions linked to that. But there's also something like a Scope 2 emission. That's an indirect emission that you indirectly create by buying it. And that's like electricity. Electricity has been created somewhere, and that has caused some greenhouse gas emissions as well. So there's Scope 2 and Scope 3, but and these are relatively easy for us as KBC to determine. The data is somewhere. It might be hidden somewhere in the organization, but it is there, and we certainly found it. But Scope 3 greenhouse gas emissions, so that are the ones that are generated in the company's value chain, but outside of our company walls. And that's a bit tricky to do because the scope 3 emissions can be, and that's on the next slide, can be twofold. They can be either the emissions of the assets that we finance via a home loan or a car loan, for example, but it can also be, in the case of a general purpose financing, the scope 2 and the scope 1 and the scope 2 emissions of the company we provide the financing to. So we must include a figure there well. But for most of these, that general purpose financing, we are afraid that the scope 2 and the scope 1 and scope 2 emissions will not be known by the clients. So let's zoom into a few examples here. Let's take a KBC home loan, for example. We've got loads of home loans in our portfolio. But what greenhouse gas emission is linked to that? Now, in order to calculate the real greenhouse gas emissions of a house or an apartment, you would basically need 3 values. You would need the EPC value, and that's the energy performance certificate, which is a value that reflects the estimated energy consumption per year in order to heat a home or an apartment per square meter floor space. That's a whole of information there. Now, we haven't systematically kept these EPC values over the year, and they only have been introduced in Belgium, because this is Belgium only, in 2008, so there's still a lot of home loans around that, of which the houses, in fact, do not have an EPC value. So what do we do with that? We also would need the number of square meters of living space in the house, which we, again, do not keep systematically. And on top of that, we should also need an idea of the energy that is consumed to maintain a certain ambient temperature in the house or in the apartment. And that's, again, information that we don't have, could be even violating GDPR, I don't know. So you see there's a lot of unknowns, but we need to report. So what do we do? Well, we use proxies. So there's a lot of proxies around. A possible proxy is that you use a sort of an average EPC value. You find the average value of a house in Flanders on the internet. It's 382 kilowatt hour per square meter. You could also find some tables with average floor spaces. The average apartment in Belgium is about 51 square meters, I think. And another proxy could be using a conversion table that directly links EPC values to an average amount of greenhouse gas emissions. But proxies might be a way to help you calculate your scope 3 emissions, but the more high level those are, and if you're going to combine them in the same calculation, your end results might get very inaccurate. And that's also not really what you want. So it's a question of data availability, in fact, and a question of data quality. Let's take a second example, a car loan. So we need to include in our CCCA reporting the greenhouse gas emissions of all the car loans, of all the cars, in fact, we provide a loan for. Of course, you can find detailed lists with all CO2 emissions of every car type around. And that's okay as a first step, but we all know that these are, well, only theoretical figures. Because what we really would need to know is the mileage of the car and the fuel consumption. Is it a granny type of driving or a pedal to the metal floor driver? The fuel consumptions will be quite different. And the mileage per year, we don't have that information, but some instances in the automotive sector might have that information. So we will need to find, and we do use proxies there. But luckily, it's not always that complicated. You have also types of loans that are very clear in their greenhouse gas emissions. For example, when you provide a loan for a solar cell system or a heat pump or a windmill or something like that, the greenhouse gas emissions will probably be part of the business case. So there we might be a bit more comfortable. And then, as I already touched on, the general purpose financing, that's a bit more complicated, because we should be able to report on the Scope 1 and the Scope 2 emissions that we in fact finance, but there's no direct link between the financing and the way the money is used. So that's a bit tricky. So we hope that the companies, in case there, can provide us their Scope 1 and Scope 2 emissions. But KBC perhaps can help here, because we have something that's called a carbon footprint calculator. It's a tool that we developed ourselves in the corporate segment, and we put it at the disposal of our corporate clients. So see your KBC relationship manager for that. So that's for CCCA reporting. Then I would like to touch, well, rather briefly, because we already covered a number of items here. The EU taxonomy is meant to steer capital flows in such a way that more long-term investments in sustainable economic activities and projects take place. So there are 6 environmental objectives that are available or in the pipeline. So only climate change mitigation and adaptation is known yet, and the 4 others we are still waiting for them. Hopefully they will come soon. Now, the intention of the EU taxonomy is, of course, to bring some clearness here. So we need to report, KBC needs to report. We need to report with 4 caps on, in fact. We need to report as a banker, as an insurer, as an asset owner, and as an asset manager. So as a banker or an insurance, you have to specify to which environmental objectives the activities of your client belong. And as an asset owner or asset manager, you need to specify on your own investments whether they are well in scope of the EU taxonomy regulation, meaning that they do contribute in a positive way to one of those environmental objectives. Now, I will switch, because you already explained about eligibility and alignment. I can go to the next slide. So that's basically the reporting calendar. So till the end of next year, we need to report on the taxonomy eligibility of our activities. So wearing the bank cap, we should report about the taxonomy eligibility percentage of our loan portfolio. As an insurance, we need to report about 2 percentages, in fact. The percentage taxonomy eligibility related to insurance investments, and the percentage taxonomy eligibility related to underwriting activities. Then, as an asset owner, report about the percentage assets linked to the dealing on our own account activities. And as an asset manager, we need to report on the taxonomy eligibility percentage related to the assets that we manage. Now, this is already quite elaborate, because we need a lot of information for that, but it's feasible. And when the remaining 4 environmental objectives will become available, the reporting will even be enlarged with all of the 6 environmental objectives. So it will be tripled in a certain sense. But then the big next phase is from the 1st of January of 2024, when we will need to be mandatory reporting about the taxonomy eligibility and the taxonomy alignment, and regarding all 6 objectives. So that's another doubling of the reporting. Now, currently we see no real blocking issues. because we're still in the first phase, in the eligibility phase. But the do not significantly harm and the minimum safeguard things matters will be a bit more difficult to maintain and difficult to get a hold of, because we cannot do that ourselves. Though there might be some screening criteria published, we need to cooperate with our corporate clients in order to investigate, in all honesty, whether their activities do not significantly harm one of the other environmental objectives. So you might be contributing to the first, but you might be violating one of the others, so you will not be taxonomy aligned at that moment. So for example, when your activity mainly is installing solar panels, but you do that in nature reserve areas, and you cut all the trees, you will probably be in line with the first objective, but certainly be violating the sixth objectives. So this was basically what I wanted to talk about regarding the EU Taxonomy Initiative. And then I would like to make a few comments regarding the CSRD that you also already made reference to. So let it be clear that the CSRD will trigger a whole lot of new mandatory disclosing requirements. Some call it an avalanche of disclosure requirements, and that might be true because the figures are quite impressive. We currently are at 13 ESRSs, including the appendixes. There's even a lot more. But we already counted 136 disclosure requirements, which each sometimes are subdivided into one or more, let's call it sub-disclosures, spread over 684 rather difficult to read pages, subdivided in more than 1,700 articles that all make references to one another. So it's huge to digest that to start off with. And then we are still missing a whole lot. We are still missing some 40 sector-specific ESRSs, and we also expect some ESRS towards the SMEs. Hopefully proportionate, as you indicated on the slide here. And let me also comment that the ESRSs are not stable yet, so the public consultation phase just has finished, and EFRAG has still the mid of November time to bundle and to consolidate all the comments and hand them over to the European Commission, where they probably will be approved by the end of November. Means that using the mechanism of the Delegated Act, they will be transposed into local law by the end of June of 2023, which leads us to the calendar that first reporting will be for companies like KBC in 2025, reporting out about the full year 2024. What do we see as main challenges here? Firstly, the CSRD, in the CSRD regulation, the sustainability information and the financial information needs to be integrated and published in your annual report. That will be the official place where the information should be found. But the degree of integration of both types of data, that's not really indicated. So we need to find a way how we would do it, including the same information of this on the same page, or both informations on the same page, is also a way of integrating, but I'm not sure that's what they envisage here. The information indeed should be physically included in the annual report, though you still hear some voices that would be in favor of including it by reference to other documents, but it will be probably physically required. And then there's the synchronization issue. CSRD wants sustainability information and financial information to cover the exact same reporting periods. And that's a challenge for KBC because our current sustainability reporting runs September, while our financial reporting runs end of year. So there's 3 months more to collect the data, but there's much less time to consolidate the data. So this, in a certain sense, jeopardizes the timing of the annual report, which we cannot change just like that, of course. So that's some issue there. As I already mentioned, 136 new disclosure requirements already known, some more coming, and some of them go really far. Like for example, the requirements on governance. There's some requirement that your board of director members should be chosen on the basis of their knowledge of ESG matters. I think that's a very new concept to most companies, but it's literally like that in the CSRD. So we'll need to deal with that. A lot of policies are expected on ecosystems, on biodiversity, etc., etc. I think we have quite a lot of them, but I can imagine that a lot of companies will not have these policies available just like that. Some other figures, more than 50% of the disclosures are pure text, they are pure qualitative. Someone will need to write these texts, so you would need some resources to do that. 36% are mixed qualitative and quantitative, so text and figures, and 12% are just figures. For us as KBC, there's, well, a positive point, of course, and that is that the CCCA reporting on the emission scopes will be fully absorbed in the CSRD. Also worth mentioning is that the sustainability information needs to be made available in a taggable electronic format, so HTML and ESF, same as for financial information, in fact. For the time being, limited assurance is required, but we have somewhere the impression that that might go to a higher level in the foreseeable future. And as Marc already mentioned, it's very important that you know about your data lineage, that you know about your audit trails in the reporting that you built, that you know why a 5 in a report is a 5, where does the 5 come from, and why is it not a 4. So that's quite important. What we are still not 100% sure of and still further analyzing is the value chain. In fact, where does it stop? Do you need to include always the suppliers of your suppliers? Do you need to include the clients of your clients? So we're still looking into that. And lastly, but certainly not leastly, there's also a lot of mentioning of opportunities, especially regarding the social ESRSs. You are supposed to identify opportunities of climate change. So that's something you might need to prepare for beforehand. And then I brought some main conclusions regarding ESG and ESG reporting as a whole. So very important, and also Philippe filled that in very well. Awareness and engagement for ESG starts really at the top, at your top management level, and it needs to trickle down. And KPIs, of course, help a lot for this process. But it's very important that you start the investigation now, that you inform yourself, that you assess on a high level what is important and material for your company. All the ESRSs and all the other standards can be found on the internet. There are no secrets there. So also think about the opportunities that you might need to produce once. And also very relevant, assess the data that you have, but also assess the data that you don't have. Where are your gaps? because you will need to set up a structure for gathering that data. And of course, data is only becomes information when it has a clear definition. So you need to have a portfolio of group-wide data definitions in place as well. Also, think of the possibility of using proxies when you're missing a lot of data. Then we make an elaborate action plan, make even a couple of action plans, but essential is that you ask for and hopefully get freed up enough resources. So set up your internal structures, define your roles. It starts with the report owner, but also all your intermediate roles need to be well filled in. Identify your data delivery channels. Define your data and metrics way of working. Put it all in well-structured databases and implement enough data quality safeguards. And then make sure to create and maintain your documentation, including data lineage and audit trail, and prepare for limited assurance from an external party. And then I would like to conclude by the point that you can also already start reflecting on how you would integrate the sustainability information with the financial information in your annual report. So, main message is ESG reporting is not a side job, something that will take an awful lot of time. It will be massive, it will be mandatory in many cases, or you will be involved in many cases. So please start in time. So Marc?
I can only agree with that. I think the overall objective is well known. It's to create a transparent, a balanced non-financial reporting. We are all in favor of that. Easy accessible, if the digital tagging we are referring to, it be very easily now accessible, that type of information, also to create comparison with peers, with other companies on specific domains of ESG. And the objective to make it robust, the disclosures. But however, yes, very comprehensive, many required disclosures. And you have to know that one KPI, we refer to 136 disclosures. But if you refer to one KPI, one KPI is a multiple of data points. If we talk about, for instance, climate change scope 1, 2, or 3, but each scope, if you then will dig down into the details, one scope is a multiple of data points that you need to gather and consolidate within your organization. So quite comprehensive. The robustness is also important because you want to, first, as a company, if you come out with non-financial information, as you do for financial information, you want to ensure that that information is accurate, is complete. You want that as a board, as an audit committee, as management, that what you publish is accurate. But also that, if you use that information internally, that it is accurate because that's on that basis that you are making business decisions. And that robustness is also one of the reasons why the regulation has foreseen that the audit, the assurance is mandatory. So if you really look to, and I'm a grown-up auditor, financial and non-financial, if we look to external audits, where do we see really that the need or the added value of an audit within an organization? One is that that overall objective of if you publish financial or non-financial information, you want to enhance the credibility of that information, that it has been reviewed, it has been audited by an independent party. So it's not greenwashing, it's not information coming out of the blue, it is well structured, there are appropriate processes, controls in place, so you have the controls internally in the organization, but you have also that external, independent verification, validation, audit. It enhances the credibility for any user internally, the organization, or externally, the organization. So it enhances the credibility. And it will also enhance, because we have made reference also to rating agencies. So also in view of rating agencies, we see a clear link that it also improves the scoring or the rating done by rating agencies, because they also see there that enhanced credibility of that non-financial reporting. But it's not only the reporting as such, we also see that, and we have seen that also in view of financial audit, but also for audits on non-financial information, that it also, if it is reviewed by an independent auditor, that we are reviewing the policies, we are reviewing the processes, we are reviewing the data gathering process, the internal controls, which ensures that the information is accurate, it's complete, it covers the full period, so that also by going through that information, through the definitions, are they properly defined, are they consistent applied throughout the group, throughout all subsidiaries of the organization, and in the different regions of your footprint. When we go through that process of validating, we also come up with recommendations in view of further strengthening your internal organization, your internal procedures, your definitions applied, your data gathering. We also come up with recommendations to further strengthen those processes, which are also important in view of your internal decision-making, your internal monitoring of your performance and setting your strategy, your ESG strategy. But also for external stakeholders, it's important that when they see that reporting on non-financial information, that they see that it is accurate, that it is complete, that they can trust that information, because also for them, it will be a way how it might influence their decisions. For somebody who wants to come to work with you, and going through how you describe your values, your culture, and how you describe how you retain or upskill your people, the person wants to see that accurate information and will take that decision that, okay, is it matching with his own values? Is it matching with how he or she sees how to develop within the organization? And that are the type of decisions which are based upon the information made available by the company through that reporting on non-financial information. So it enhances credibility. It enhances also the scoring on ESG domains. It improves the internal organization and the audit, but also it improves also the trust by the various stakeholders around the organization. So if you put it somewhat in the different buckets, so one, and I already alluded to that, it is enhancing the credibility, but also at the level of the board, because it becomes a board responsibility, the non-financial reporting and the audit committee responsibility. So also for the board, it is important, the audit committee and the governance bodies, it's important that when they go public or they approve this information, they go public with this information, that they have the comfort through an audit, an independent audit, that the information is accurate and complete. It is giving comfort to the investor. If a private equity, a fund, a company wants to acquire another company, going through the non-financial information and screening that information, that they have access to that information and can spot the ESG risk or opportunities on which they want a leverage upon in view of that acquisition. It strengthens relationships with the various stakeholders. I make reference to your recruitment process, your customers, customer behaviors, so the different stakeholders around the company. It will strengthen further relationships, being very transparent and balanced in your reporting, and I already referred also to the external rating agencies as well. So quite important in view of that added value of an assurance. Maybe just a small word about assurance, because we are referring to assurance, but there are two types of giving an assurance. You have limited assurance and reasonable assurance. As of today, the regulation foresees a limited assurance, but with the objective to move towards reasonable assurance over time. Maybe first, very important, independent of the type of assurance, as a company, it is important that if you report upon non-financial information, that the information is accurate, is complete, is in compliance with the regulation, independently of the type of assurance. So the type of assurance is not an indication that the robustness of the process or information should be less because there is only a limited assurance. No, that's independently. So the information has to be accurate and complete as a company to go public with this type of information. The only difference between a limited and reasonable assurance is the depth of the procedures performed by the independent auditor. Through a limited assurance is what we call is a negative assurance. So we will indicate that we have no indication that the information published by the company has not been prepared in accordance with the regulation. So it's negative assurance, which means that the level of detail of the audit is limited, is less extensive. It's mainly through inquiries, reviewing the policies, performing analytical review, to have sufficient comfort that we can conclude that that we have no indication that the information has not been prepared in accordance with the regulation. A reasonable assurance goes in much more extent in the type and the scope of procedures that we will perform. The number of samples, the detailed testing that we will do is much more extent, is much more large. So it's much more detailed. And because there we give positive assurance. There, we will conclude that in view of the company that the information published conforms, so it's a positive conclusion, conforms in all material respects with the criteria, with the regulation. So this is a positive conclusion, but being able to do so, the procedures executed by the auditor will go in much more detail, will be much more in extent. So that's important to make that difference. It is not because it is only a limited assurance that would give less need for the robustness of the processes and the internal controls within the organization, because that should be a given. To have that robustness on the internal controls and processes. So I believe that this gives a good overview of the regulation, the CRSD, as well as the EU taxonomy, but as well as the fundamental building blocks in view of coming up with that non-financial information, in view of defining that scope through stakeholder engagement, double materiality, really defining the boundaries of your non-financial information, being able to comply with that regulation, which is quite important in view of all stakeholders having access to that information, but also, as you have illustrated, also for financial institutions, enabling them to report accordingly as well on their product portfolios, but also being able to steer that capital flow, that you have that transparent, well-classified information in view of steering those capital flows to sustainable economic activities, but also for investors, private equities, funds, other companies, having a look to acquire other companies, having that transparency in view of that non-financial information, those sustainability risks and opportunities on which they can then leverage upon. Thank you for that.
Things to remember are words like massive, comprehensive, accurate, robust, big. And I don't know if that means that our clients, internal or external, should be happy or optimistic, because there's a lot of work at hand. But anyway, KBC and our partners are prepared to help. So this is basically why we're doing this. We received a lot of questions. I stepped in a bit prematurely earlier, but that's no problem, because following on that one, we did receive a lot more questions. So there was some benefit to that anyways. I'm going to repeat the question that we received in the beginning of the presentation. And I think that is something that Marc should be able to answer. Client asking, when I provide KBC with my non-financial data, will this have an impact on the credit process, the credit rating, or on the conditions on the loans that are supplied by KBC?
I'm Luc, and I will be happy to respond to the question.
Sorry.
So at this point in time, this is not the case, at least for the vast majority of the sectors, but we already do exclude a number of sectors via our policies. If there would be an influence on loan conditions, that would at this point in time rather be a positive influence in case you are already engaging yourself in ESG activities. Now, KBC does realize that collecting and reporting non-financial information might be something very new to you. but the same goes for us. We also have our own reporting obligations. So we are a bit in the same boat here. We are still enhancing our own structures to get it all done by, well, early 2025. What we want clients to know is that KBC is there to help you, and that we will help you in the transition towards a more sustainable future. And we will continue sharing insights with you like we do here. But please take things in hand as soon as you can. Start informing yourself, try to follow the steps that we indicated here, and don't forget that there's always a possibility of discussing this with your KBC relationship manager.
Yeah, communication is key, of course. There was an interesting question, starting with my company is an SME. As, of course, you covered a lot of ground and a lot of details and a lot of regulations and disclosures. Well, if indeed a company is an SME, how will the new CSRD apply to those companies? I think that would be something for PricewaterhouseCoopers to answer.
Very great question. And I hope that those people which are in that spectrum of SMEs have not switched off, having seen the criteria. Because no, absolutely, they will be impacted, I'm pretty sure, for that. Even if we are below the thresholds that we have demonstrated in view of the applicability of the law. Yeah, we are a country of SMEs in Belgium. Yes. And those SMEs fit into the supply chain of large companies, of listed companies. So those listed companies, large undertakings, listed SMEs as well, are within the scope of the CRSD, and they will need to report accordingly with a view throughout the supply chain. It means that if you as an SME are fitting in that somewhere in that supply chain, that you might expect that those companies will come back to you and indicate, well, I need additional information. I need the information on your footprint as an SME. I need to have an indication of the footprint of your specific product that you supply to us, which is a part of our product or service which we put on the market. So you might expect that you will get surveys, questionnaires, questions about the different ESG domains because of your part of the supply chain. Not only that, I hope that also demonstrated clearly throughout my presentation is that you should not only do the non-financial information or the building blocks of the non-financial information because of external reporting. It is anyhow important also in view of defining, fine-tuning, revisiting your overall business strategy. I think anyhow you have to look to your ESG risks and opportunities, how you can leverage on that, how can you mitigate that in view of your overall business strategy. But also thirdly, our SMEs on the market, they also are in need of cash in view of being able to grow further, being able also to acquire startup companies or whatever. And being able to access that cash, we will see that more and more. One, there will be funds at EU level, at government level, in view of really promoting the transition towards a more sustainable economy, low carbon economy. So being able to having access to those funds, if you can demonstrate, if you can report that you indeed are investing in a sustainable economic activity, will probably enable you much easier to have access to that cash. But also towards financial institutions, also there, I think if you will go through green instruments or alike, but now I will give the word to Luc, which is much more specialized into those financial instruments. But also there, I would believe there is quite an interest also for SMEs being able to be very transparent about their ESG strategy.
Yes, indeed, and I even cannot add a lot to what you just told, because we are definitely in scope of the CSRD, even in the first phase. So we will definitely need information about parties in our value chain, in fact. So we will come to the SMEs. They will be involved in the CSRD story, probably from 2023 on, but for sure in 2024. And that's despite the fact that officially the bulk of the SMEs are not themselves in scope of the CSRD, but they will be involved in an indirect way because we need their information, because we need to report on it. But as I already said, KBC is ready and able to help you in that.
Right. So rather than big or small, it's just a matter of what you said earlier. Start with it and go with the flow. Another question, and I have to shift through the list a little bit, is about the EU reporting standards. How will they fit with other global standards, like, for example, the ISSB? Probably, Marc, that's one for you as well.
Yeah, absolutely. Well, yeah, and again, a pretty good question, because I think we started off with the overall objective of the CRSD and the ESRS standards in view of standardization. If you look to today's landscape of non-financial reporting, we have a lot of voluntary reporting schemes. We have, I already indicated that you have GRI, you have CDP, IRSC, TCFD, and then also if you look to the rating agencies, a lot of rating agencies also around with each time their own lens in view of scoring companies on their ESG performance. So the overall objective of the CRSD with the ESRS is standardization in view of the disclosure, ensuring that reporting becomes comparable. But indeed, we have seen now with the foundation of the ISB, so we have now the ISSB, the International Sustainability Standards Board, which has also come up with the reporting standards and also in consultation modus as of today. So there are two standards. So you have the IFRS S1 and IFRS S2. IFRS S1 sets really the general requirements for disclosure of sustainability-related financial information. And you have the IFRS S2, which is very specifically around climate-related disclosures. And there we indeed already see that how the lens is used by the ISSB is in some areas quite different than the CRSD or the ESRS, where that the ISSB has taken more the financial materiality concept, has the CRSD taken the double materiality concept. So the ISSB is more looking at how can ESG, risk and opportunities, have an important impact on the overall enterprise value of a company. It's more the investors look towards the enterprise value of a company, whereas the ESRSD has a double materiality. And that, of course, might become confusing for companies because if they now have to apply to both standards, again, in view of annual report, and we have already the struggle of the number of disclosures, but then if you have on top of that, a misalignment between how you need to disclose based upon different concepts, that might also confuse companies, but also persons using that information.
Yeah, we're still at the beginning here because there's only two standards from IFRS published. That's number 1 and number 2, a general one and one on the climate. But there's a lot more ESRS standards or draft standards around for the moment. So we are still waiting for an impressive portfolio coming from IFRS to cover all the other domains like governance, like social, like the other environmental stuff aside from climate change. So if there's already some discrepancy now, who knows what the future will be.
Yeah, and the question, the person only refers now to ISSB, but we could also make reference, because if you're talking about global operations of companies, what about the compliance with the SEC, the US regulation, which is also defining their standards on ESG. I'm pretty sure that Asia China, will also come up with their standards. So as a global company, the objective is standardization, but we have the risk that there might be misalignment between the different standards applicable for a company.
Also, let's not forget that the ESRSs will become mandatory. Those disclosure requirements will become mandatory, while this is not the case for the ISSB standards till now. But all the European Union companies and even some non-European Union companies will need mandatory to report following the disclosure requirements. of the CSRD.
All right. Again, this explains why the question is there. So companies are really in a dire need for clarification and standardization. But what does that exactly mean? So partnering and help is good. I have another one coming in. Whether or not it is recommended for companies to already have an informal audit of the non-financial data, as you've been discussing, before the actual legislation kicks in. So what's the timing and how fast should they act? Maybe that can be a trial run, maybe that can be a formal thing.
Yep.
Any of you can...
Absolutely, and I'll start as an auditor.
That's something in your basket, I think.
Yeah, no, absolutely, because I've indicated the timeline, 2025, 2026, and you might think, it's okay, still quite a time ahead of us to be ready for the audits. In our today's conversations with companies, we have two recommendations. In fact, we have a lot of recommendations, but at least two recommendations. One, start today with the gap assessment. Although we know that the standard is still is still not final, but go through the standards and do already a gap assessment to see, okay, where do you stand today? Where do you see going through the standards? What are your main challenges to be able to comply with the new regulation in view of EU taxonomy, in view of CRSD? That you really have that roadmap and that you really can define your milestones, what to prepare by when, to ensure that you are timely ready. That's the one. That's the readiness check, gap assessment. The second one that we absolutely also recommend is start early enough with the assurance phase, the assurance readiness phase. And that's what we call a kind of pre-assurance or an assurance without consequence.
Okay.
It's a tryout.
A soft assurance.
A soft assurance, you name it how you like, but it is a kind of doing an assurance on a limited basis, limited samples, inquiries with management. Okay, show us your policies. How have you defined your material domains? How have you defined your KPIs? What is the definition of KPIs? How do you ensure that the information is gathered in a consistent way? How do you ensure that it is accurate? We do limited testing just to ensure that what you tell us, does it really, or is also aligned with what we see in practice. But without any objective to go public with that, but as an internal management letter, as an internal recommendation to further strengthen really the procedures, the policies, the data gathering for the companies, enabling really that tryout, that when you are all in the year of mandatory assurance, that you take away that surprise or that hurt, because as indicated, the timeline of that reporting is aligned now with the financial reporting.
True.
And that will be I think one of the main challenges we see with companies is that where we use that for companies who are already quite mature in non-financial reporting, often the non-financial reporting came at a later stage in the year than the financial reporting. They had their financial reporting February, March, and we see that most of the sustainability reporting comes out for companies May, June. But given now that the board is responsible also for the non-financial information and that it has to be embedded in the annual report, in the board report, so you have to advance that whole reporting and you have to ensure that your processes and systems are aligned with that and that you're able to gather that information in a much shorter time frame after year-end, enabling that it is embedded in the annual report and goes through the necessary governance bodies internally in the company in view of validation, but also then giving sufficient time to the auditor, giving us time to audit that information. So that's what we also see is one of the most important hurdles as well as the timing aspect.
Right. That's something, look, we can agree with at KBC.
Yes, absolutely. Couldn't explain it in a better way than you did.
There was a final question that I'm gonna have here. The rest will be passed on to the concerning what you said. Well, you have to give the auditor time. There's going to be a massive demand for all these things and checks and balances. Is there enough capacity? Because if everybody's going in at the end, there's a bottleneck effect. And what can the impact be on the timelines?
Yeah, and in fact, I will respond to the exact question, but I will start maybe as an introduction of that question is not only the capacity at the side of the auditor, there is also the capacity at the side of the companies, because we see that there is an enormous need of skilled people around ESG, and that also the companies are facing the struggle in finding the right resources.
But also
skills.
you, perhaps.
Yeah, well, and we also a lot approached by companies that. So it's important to start early and also to ensure, okay, do you have the right skills internally, or do you also will go externally or to advisors in view of helping you out and building up that ESG reporting? But indeed, a very good question is also, do the auditors also have that capacity in view of, one, helping out clients and building up, but in view of also of auditing as an independent auditor, the non-financial information. And that's something that we have already started up within our organization, and building up a team of experts in view of ESG reporting. And that is something which we did already for quite some time. I'm already auditing sustainability reporting for companies which already has gone through voluntary auditing.
Right.
So I did it already in the last decade, 15 years. I'm auditing already sustainability reporting. So we have that capacity. But the only difference now is really given the scope of the entities is we need to upskill that capacity enormously. But of course, we have also our financial auditors. And one of the main tasks for me and our organization is also that to upskill our financial auditors, enabling them also that having that skill, not only to audit financial information, but also the non-financial information. And in view of the audit techniques as such, there is not a lot of difference in audit technique, because we refer to the audit trail. So what we do in view of non-financial audit, but also as for financial audit, what we will ask companies is, okay, but you are reporting a figure, 1 million as a turnover, or you are reporting CO2 emissions, X ton.
Same thing. Yeah.
Well, we will ask you, okay, how have you come up with that figure? Show us indeed the trace towards the source document. Is it then your electricity bill or whatever? Show us how you have come up with that calculation, and we will audit on that basis, on a sample basis. We will trace the documents. So as an audit technique, it's quite similar, but the difficulty is the technicality of the topic, which is totally different, of course. You need to speak and to have, of course, that technicality. You need to know, how do you calculate carbon emissions?
Voilà.
Is there a new war for talent erupting?
Yeah, absolutely.
All right, good. I'm going to have to wrap up. It's about time. Thank you very much, Marc from PricewaterhouseCoopers, Luc from KBC. Very insightful, very comprehensive. I'm sure our clients will be very happy with it. As to the clients, don't walk out on me just yet. There's one remark and there's 2 call to action. The remark, there seems to have been some problems between the synchronization of audio and video. This will be corrected in the afternoon should you have had some problems with that. Our deepest apologies. They will be corrected, of course, also in the recorded version. 2 calls to action. There are a lot of questions which have been left unanswered. Don't worry, we will get back to you with that one. But more importantly, as the scope of this presentation was large, there's a lot of questions, I'm sure, in your heads. Do continue to send them over. Release your inner Clint Eastwood and continue to shoot like crazy. Finally, yes, you are duly invited for this afternoon for the 2 panel discussions. As said, one with our project finance team that will participate in a discussion with actors in the energy market on the Belgian offshore wind. And secondly, at 3 p.m., that's the export finance team that together with 2 of the core clients will zoom in on how the United Nations SDGs can be applied and used in export financing transitions. That's it for us for this part of the day. More to come. First, enjoy your lunch. We'll be right back. See you soon.